Hello guys, this is Vineet from Edge Forex and today is 25th of July 2025 and there's not much really happening in the markets. They're rather quiet. There is no news. Things are kind of at a status quo level. I thought today I'll talk about something different like I have been for last couple of days, and today I want to talk about housing. And how it's becoming more and more out of reach for a common man, not just in US or Canada, but across the globe, across, say, Canada, UK, even places like Singapore, Switzerland. So housing has gone from a human right to a luxury asset. And now with commodity soarings, population swelling, everyone's asking, can this madness last forever? So let's, before we dive into the data and we get into the details of things, I wanted to show you guys this chart, this particular chart. What this chart is: the years of income required to buy an average house, not a luxury house, an average house in each country. So the most expensive by far is Hong Kong. So when year 2000 started in Hong Kong, you needed 10 years worth of your income to buy an average house. Now you need over 20. So imagine, guys, you have to work, save 20 years worth of income to buy an average house. How ridiculous is that, right? And Singapore is not far behind. They need over 10. And then we have countries like Australia, we need like 8 or 9. Canada, we need 9 to 10 times your income. The only country, let me show you what by country, okay, guys? Here. So that's for the USA. That's the only country where it's a lot, looks a lot better, but it's still a lot. You need over 5 years of your income saved to buy an average house. And that's the only place where it's that low. If you look at some of the other ones, for example, Canada, you need 9 years to buy an average house. Guys, this is ridiculous because I know Canadian housing market firsthand. And right now is dropping, is crashing like anything. But still, it is way out of whack. In the year 2000, you only needed 3.5 years of income. Now you need 3 times as much. This is ridiculous, guys. Okay, so here UK again, you need 6 years. Germany, you need 4 years. Australia, you need over 9 years. Switzerland, 4 years. Hong Kong, 20 years. Singapore, 11 years. So it gets really, really ridiculous. So now let's break down the data, the cycles, and the economic truths, because if something doesn't give soon, either the prices will crash or inflation is going to come in through the back door and do the job instead. Think 1970s. Same thing happened. This is not the first time it's happening. It has happened before. And I think I know where things are headed. It's going to be, I'll give you my conclusion at the end. So let's start with Hong Kong. So it takes over 20 years of median income to buy a house. In Canada and Australia, looking at 8 to 10. And in London, good luck, nothing less than 12 to 13 times if you're looking at major metropolises. So, but here's the twist. If, again, I've already said that before. So what really happened? 3 things: cheap money, financialization of real estate, and restrictive supply policies. Add population growth into the mix, and you get a perfect cocktail for runaway prices. So, but see, there's a problem now. The math has stopped working. You can't keep growing house prices 10% a year while wages don't go up at all, or they grow at a lesser pace. So it's getting to a point where we're at a crossroad at this point. And for the investors out there, here's a Forex twist. The price to income multiples distort national competitiveness. Countries with housing bubbles often see currency volatility, reduced consumer demand, and fragile banking sectors because majority of their incomes are going into housing. So they do not spend elsewhere. So everything else around the economy other than houses gets affected if the housing is in a bubble. So now let's talk raw inputs. Do I have a slide for that? Yeah. So Steel. So if you want to build a house, you need steel, copper, concrete, lumber, and they're all up. Copper in particular is trading at its all-time highs. And then it's it's really, really coming to a point where even cement, iron ore, they're all trading at close to all-time highs. So the input costs are going higher by the day. So in a normal world, rising commodity would cool demand. But in real estate, builders are just passing it on to the buyer or stop building altogether. This has created construction bottleneck that amplifies the affordability crisis. So why not just build more homes? Well, it's not that simple. Zoning laws and then over a regulation that chokes the supply. In Sydney or in Toronto, approval processes can take years. In Germany and Switzerland, environmental restrictions they cause huge delays and add to the cost like anything. This isn't a demand side bubble. It's a supply side disaster married to a commodity inflation cycle. And if commodity prices keep climbing, the imbalance becomes even more dangerous. So let's zoom out. Population in these countries are growing not through births but via immigration. Canada, for example, they added over 1 million new residents in the year 2023 alone. Singapore is seeing similar population pressures. But while population has gone up, incomes have not kept pace. In fact, in real term, wage growth in the US, UK, Germany has been flat or negative when adjusted for inflation over the last decade. Now, that's a ticking time bomb. More people are chasing fewer homes with weaker wallets. This isn't sustainable. You don't need a PhD in economics to see this fact. At some point, either their income explode upwards or housing prices have to come down. So I think one is far more likely than the other. We'll see. Let's be brutally honest. If it takes 10 years to buy a home, it's no longer a home. It's a wealth filter. And that filter is breaking societies apart. Young people are getting locked out. Middle class families are living paycheck to paycheck despite owning $1 million home. And governments, they're stuck, afraid to pop the bubble, but terrified of what happens if it grows further. So again, I said, we're at a crossroads. And I think cracks are starting to show, especially in countries like Canada and Australia. And I think it's going to trickle down to the rest of the world. So some central banks, they have raised rates, hoping to cool demand, like Canada, like Britain, even US. Others have thrown up their hands. But here's the truth. Prices at these levels cannot be justified without a massive wage inflation. Think inflation, guys. Again, all boils down to what do you want to own as an investor? Hard assets, hint, hint. And this brings us to the fork in the road. Either housing prices fall or inflation incomes meet them. So now we arrive at the core economic tension. If housing prices stay high and incomes don't catch up, the system breaks. The default rates rise, the demand collapses, and the crash becomes inevitable. But if government and central banks allow inflation to rise through wages subsidies, fiscal expansion, or outright monetary loosening, they can avoid the crash at the cost of devaluing money itself or the currencies themselves. Again, as Forex traders, it affects us. We need to know what's happening in these markets so we can create that wholesome picture. And with these series, guys, I'm trying to tie a lot of pieces together and as to why Forex trading makes a lot more sense than just going into commodities or stocks because they're individual sectors. A forex exchange rate of a country says a lot. Is a combination of hundreds of things that are happening in that country at any given point. So let's get back to our topic. So what do you think it'll be in places like US and UK? We're already seeing wage inflation creeping in. In Canada, Australia, mortgage deferrals and social programs are masking the deeper rot. So my take. What is my take? Housing prices won't collapse in nominal terms. I don't think they won't collapse. They are going down. They may go down 10, 20, 25%. But in real terms, So if a house is, say, $1 million today, it may come down to 800,000 or even 750. But adjusted for inflation, they'll decline. That means it's a stealth reset. Prices stay flat or go down a little bit, but inflation eats away their value while wages play catch up. So it'll always be a catch up for the middle class families and the new first time home buyers. This isn't wishful thinking, it's exactly what happened in the 1970s. And the US high inflation solved the affordability problems eventually. But the initial years, they were horrible, horrible. So, what should we do as investors or traders? Lean into hard assets, commodities, precious metals, inflation protected bonds. And yes, there are some real estate plays in the growth corridors. I would stay away from them right now. Wait for another 20-25% drop. If you're looking to buy a house, I would wait. Prices are going down, especially in countries like Canada. All the countries that I mentioned, prices other than Singapore and Hong Kong, see, they have a different kind of problem. They are running out of space. See that now that's a real headwind. They've hit a wall. So now the countries like Canada, there's no shortage of space. America, there's no shortage of space. They can keep building houses till kingdom come. But the input costs and the regulations, all those things are going to increase the actual building costs of the house. So that said, again, stay away from buying a house if you can. If you really have to live, that's fine. So now we need to watch currency. So if inflation rises, eventually across countries, expect sharp movements in the forex market. The yen, for instance, could surge if Japan starts raising rates. Aussie dollar may falter if rate hikes hit household debt. So this isn't really a housing crisis per se. It's a macro repricing of everything. And we need to get our portfolio ready. We need to get our strategy straight to kind of ride the storm to the other side. So again, my favorite plays are, again, I'm repeating myself, and I try to make this point over and over again, get something that nobody else can print. Get something that is nobody else's liability, because they can always walk away from their liability. Put your money in a currency that you know will be needed for the rest of the world to buy the commodities, which is the US dollar. Get after inflation protected bonds. Yes, all these things are going to make sense for the next 2, 3, 4 years while this reset is happening, because you want to maintain your purchasing power. You should be your goal number one for your family. You owe that to your family to maintain your purchasing power. So I think that's all I wanted to cover. I hope you guys liked it, got a point or two out of it. And tomorrow I'll try and do like a weekly wrap up. And if you want me to cover something in specific, do let me know, and I would be more than happy to cover it. All right, guys, I'll talk to you tomorrow. Bye.